I have a daily radio show hosted on the TFN network. It's nationwide, a lot of different radio stations throughout the country. It's also available anywhere in the world online or on your mobile phone. And if you go up there, we have a link at the top of the page on most of the pages, tradingpub.com/apex. You'll be able to learn a lot more about what we offer, and a lot of it, I'd say 98% of it, is free. So free is always good, right? And I trade for a living, and it's love to help other traders out. I'm also joining up with Benzinga, and with Kyle. I know he's coming on here in a little bit, and I'll be a commentator on there, and also in the MarketFi education section. That's all wrapped up, and I'll just start uploading some stuff this coming week. So let's go ahead with that and get started. Let's see here. We got some basic disclosures. I'm just going to put those up there real quick, let you see them. Basically, these are unique strategies that I teach. And right here, I got to go ahead and throw up the risk disclaimers. Any kind of trading, futures, options, forex, whatever you're trading involves risk. And one thing that is unique about this, one of the things I'll be teaching you today, is one of the strategies, actually, you don't have to worry about that disclaimer. You can lose more than what's in your account, because you can never lose more than what's in your account. So, because it'll be 100% defined risk. I'll also be showing you the ultimate hedge strategy. I'm going to build up to that, so that way you fully understand it. And so let's go ahead with that. All right, so now let me start off with this slide right here, okay? And we're just looking at a pound dollar. By the way, you can apply this to a lot of different markets. I'm just giving you an example right here on the pound dollar FX. So maybe you're a stock trader, maybe you're a futures trader, maybe you like ETFs, whatever. And I'll show you a lot of the different markets you can apply this to. And let's say you see a trend line. For whatever reason, you see that trend line, you think, okay, well, it's going to bounce off this, keep going down. You might think it's going to pop up, but, let's just say that traders looking at it think it's going to go down. And it's not a completely unrealistic thing, all right? And so you decide to go ahead, put a stop. You're going to be a good trader, so you want to have your stop losses, okay? And, you definitely much rather get stopped out than wiped out, so you put a stop up there. And, you don't want to put a few pips, a few ticks, few cents, whatever, above the high. And because you don't want them just to knock you out by a couple ticks. Everybody hates it when that happens. And so you go in, you're going to sell a lot of the pound dollar. That's, 100,000 units of currency. And you're going to sell it at basically 1.5685 right here. You're going to have a stop right above the high right there, 1.5750. Your risk on the trade is going to be $650 if you did a full lot. Now it'd be like $65 if you did a mini lot. The margin, the amount of money you have to put to place the trade, a little over $3,000 to place this trade. Well, boom, that happens, okay? And no, I'm sure that hasn't happened to anybody in this room at all. So, but you go in there, you put your stop up, and bam, gets hit. And we all hate that. And probably the most painful part is not even the stop, even though of course that's the most painful to your account. The most painful part is all these ticks right here, right? Your heartbeat, boom, 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 boom. And you're like, don't hit my stop, don't hit my stop, don't hit my stop. And you're trying to figure out, what am I going to do next? Okay? If this does hit my stop, do I get in again and go short? But then, of course, what if it keeps going long and stops out again? Well, maybe I should go long. What if it falls back down? Well, maybe I should do nothing. And then you watch it go in the original direction, and then you cry because you could have made all that money back and then some. So yeah, I'm passionate, Darrell. So I'm gonna try to slow this down as much as I can. But I do have videos that are step by step that I go very slow on, that are free. Anyway, so yeah, you get hit on that, and you're just like, and that's painful. But there's one thing that's more painful than that, and that's on the right after that. Okay, bam. You went short right here. It hits your stop because you're being a disciplined trader, and then it goes right back into your original direction. And you just, you're like, man, maybe I shouldn't have used a stop. The next time you don't use a stop, and then it keeps going up, right? So all these psychological games happen to you. What I'm going to show you today is how to never have that happen to you again. Does that sound good? Literally, how to never get stopped out doing this exact same trade, how to never get stopped out on this trade again, and actually have time to be right. So I'm going to go into 3 important things you have to know to begin making money in trading. I'm talking about consistently, not just 1 or 2, but day after day, month after month, year after year. Okay? I'm going to show you how to reduce your risk by up to 75% or more while having a stop loss that's 400% larger than what you're currently using. I know it sounds crazy, but I'm going to show you exactly how it works. And uh, this is going to help you decrease your probability, if not eliminate your probability, of getting stopped out by a spike in the market. I'm also going to show you how to put stop losses on current trades you have right now for pennies on the dollar with a whipsaw elimination strategy. And I'm going to show you how to do what's called the ultimate hedge strategy, which completely hides your stops from the market so they can't hunt you down anymore. And I'm going to go into a unique type of spread. This is not going to be a vertical spread, a credit spread, a debit spread, a calendar spread, a diagonal spread. It's something completely unique. So unless you've been on one of the other webinars I've done with TradingPub or been over on our site, you've never heard this before or even anything close to this. If you have, you probably still are going to benefit because every time I go through this, people always say they pick up more and more. And we're going to wrap up. I'm going to show you how to know how far the markets are going to move today, each and every day, which is it's pretty sweet. It's insanely accurate. And we have this right now for Forex and futures, and here in the next few weeks, we're going to have it for over 3,000 stocks, ETFs, and indexes as well. So, but I was going to show you how far to know the market's going to move on each day, which is great for setting stop losses, for doing reversals, for tightening your trailing stops, for knowing when to stop adding into a position. So there's a lot of benefits. And so we're going to go in, and you don't want to miss any of the steps. So because there are several things that you really do have to pick up on, and you'll retain a lot more if you take notes. So, if you get pen and paper or have a notepad out or whatever, write some things down that we cover. We are recording this, but it helps you retain more if you do take notes. And I'm going to answer all your questions I can right here. If you want to call into my radio show, you hop over through that link right there at the top of the page, and Morgan will send you a link to our site, and you can listen on the radio show. I'd love to take any questions that you have. Also, we have a trading forum that's free. You can ask questions. I answer it every day. And I do try to get the emails, but basically I respond to the forum and other things like that faster. So, but I'll definitely stay on here to answer as many questions as I can for you. All right, to make money in trading, the first three things. And right here, you need to learn these three things. One, you need to reduce your risk. I think everybody would agree with that, okay? You have to reduce your risk because it's not what you make in trading, it's what you lose. So there's a interesting, it's a little bit vulgar, movie called Floored, and it's about floor traders. And it goes into these floor traders trying to make their move from the floor to electronic trading and everything else. And one of the things you're going to hear over and over from them, it's not what you make, it's what you lose. So you got to learn to reduce your risk. The second one is you got to increase your leverage. You need more buying power, but you got to combine that with reduced risk, and that seems a little impossible to do. We're going to show you how to do it. And you need more time to be right. So like on that pound dollar trade I showed, you were right, but you didn't have enough time to be right because you got stopped out. So we're going to show you how to give you more time to be right. So again, write those things down and let's get going. What we're going to go over today is new information, okay? To probably, I'd say, 80 to 90% of the people in the room today. And I want to normalize you a little bit to let you know you're probably going to feel a little bit overwhelmed, all right? I'm going to break everything down step by step, and I guarantee you it's not rocket science, okay? It's really simple, but it's new. So feel free to ask questions, and feel free to hop over to our site there, and I'll be happy to help you with anything you want. We even do live trading room webinars on Thursdays, educational webinars. I answer all your questions, pull up charts, and I mean, sometimes they last an hour, sometimes they go 3 hours because I stay on until we answer everybody's questions, okay? And also I have everything I'm going to be going over today in 15-minute sections. This is really gives you the good overview of how it all works together, but you'll have everything you need to do it today, but you're probably going to want more, and so just make sure you go to that link right there, go in the forum, check your email, and you'll get access to it. Some of you can handle rocket science. That's true. So with Nadex, okay, and you may not have heard who is Nadex. All right, so Nadex is the North American Derivatives Exchange. All right, they're in Chicago. They are a commodities exchange. They're regulated by the CFTC. They have the exact same classification as the CME. All right, they're backed by a multi like 9-10 figure company that's publicly traded, okay, called IG Group. And so they're not a fly-by-night. They're not a little thing. They're huge. There's no commissions because you get to be a direct member of the exchange. And they discount your exchange fees based on your order size. I'll show you that here in a minute. It's pretty cool. They give you free platform access. They give you free data. There is something for non-Nadex students. Morgan, if you want to post that information, I put over there on Skype. And you can place trades, whether you want to go in an up market, a down market, a really volatile market, back and forth, or flat markets. So there's all different types of strategies, and I teach tons of different strategies on this. Again, free. And now there are binaries on Nadex. We're not even going to get into binaries today. We're going to be talking about the spreads. Okay, if you want to learn more about binaries, how to trade them, then just hop over to our site. We'll have more on that. But today we're going to focus on the spreads because we only have so much time. Okay. All right. Now, again, they're an exchange, which means you get to be anonymous to other traders in the market maker. Okay. They don't know who you are. They don't know if you're getting in or getting out. They don't know if you're winning or losing. That's very important in any kind of trade. It's not an OTC, over the counter, the other guy's playing against you type market. And the market maker, other traders provide liquidity to the market. The market makers are required contractually to provide liquidity. So liquidity is not an issue. I've never had a problem getting orders filled. Okay. And sometimes I place some pretty large orders. And you can go on there, and again, they don't know who you are. How much does it cost? Okay, there's no commissions. They're just exchange fees. Just like if you trade at the CME, it's like $1.14 a side, like I say, an S&P E-mini. Well, on Nadex, it's 90 cents per contract per side, but what's cool is they cap it at $9. So if you have 10 contracts, that's $9, or if you put on 200 contracts, it's $9. So that is really nice. It definitely saves you a lot of money, plenty of liquidity. Here's another big thing. People go, what is the volume? Volume is what has been traded. Liquidity is what you actually can accomplish, and you'll see that liquidity being consistent. So how much can I get filled is what you're really concerned with, because the price of the Nadex spread is not driven by the demand of the spread. It's driven by the underlying market. If the market goes up, the price goes up. If the market goes down, the price goes down. Okay? All right, so when can you trade these? Well, what we're about to talk about. Well, from 6 p.m. to 4:15 Eastern time. This is really for day traders, but you only have to have $100 in your account. Now, you can also have $1 million in your account, okay? Everything is $100 defined risk trading, but literally if you have just $100, you can open an account and start doing this. And they even have a demo account and everything else that you can take advantage of. Again, 6 p.m. at night. So if you're a part-time trader, you want to come home at night. I did several webinars this week at night where I went on. I did strangles and things like that. I traded the news on the Aussie. Very simple, very easy, quick trades, 100% in 15 minutes, return on investment. So over and over and over again. And so again, you can do this at 6 o'clock at night all the way to 4:15 the next day, depending upon what market you're trading. You can use these contracts to swing trade, trend trade, random walk trade. That's like, straddles or strangles. Neutral trading, butterflies, iron condors. You can do scalping, like you're going in for small movements. There's a variety of different scalping strategies you can take advantage of. So there's a lot of things that you can do. You can do calendar spreads. You can do diagonals. So you can do all the stuff we're talking about, but with less money and less risk. So it's very beneficial. So what is this Nadex spread? Okay, they call them bull spreads, by the way. I call them bull bear box spreads. Bull spread is a bad term for it because it makes you think bullish. And basically, it's a box. It looks like a box if you put it on a chart. And you'll see why, because I'll actually show you some charts with some boxes on them here in a second. And basically, if you think the market's going to go up, you buy it, and the market's going to go down, and you sell it. Now, you can get more complicated than that, but that's just like any other market. You buy it if you think it's going to go up, you sell it if you think it's going to go down. Now, they are an option, but they're not call options, put options, verticals, anything like that, okay? They're totally different, and they're simpler. You don't have to worry about all the Greeks. One of the main reasons is because they're one day. So, some of you out there may have traded Friday expiration options, and you love them because they're cheap, and you have massive gamma. You have, like, no Vega impact at all, barely at all, because basically you have no theta because there's no time. So you just get to take advantage of the movement at a very low cost. Well, imagine getting to have that every day, and that's what you can take advantage of. Let's see here. Just went into that right there. And, okay, now I want to talk about margin a little bit to give you some comparisons, all right? So some of you are trading securities, which is great. I've traded securities. I traded, especially options was sort of my first love in trading, you could say. And that's what allowed me to quit my six-figure job and start trading for a living. It was fun to go to my boss and tell him I got to quit because it's costing me money to come to work. So options are awesome. But when you go in and let's just say you're trading a security like a stock, um, you could have a cash account which is no leverage. So if you put up $100 for a stock that costs $100, you got to put up $100. $100 is your maximum risk. Now the stock would have to go to zero. I understand that, but I mean it could be WorldCom or something like that. Now most people have what's called Reg T margin. They don't even know it, but they put up say $100 stock. They put up $50 to buy the stock. Okay, and that allows you to have 2-to-1 buying power. Now you can also go over to futures, which really can either you love it or it scares you to death. Okay. Because there's uncapped risk, and you can really, if you don't have razor sharp discipline, you can get wiped out pretty easily. There's initial margin, there's maintenance margin, there's day trading margin, which gives you like 10 to 25% discount. Also, you have day trading cash market hours on some brokers where they only let you have the discounted margin between say like 9:30 and 4, Eastern time. Like Thinkorswim, things like that. And I mean, they're a great broker for options. I highly recommend them. But for futures, I mean, they don't give you that margin break at night. So you can really get a lot of buying power with futures, but also they can be sort of scary. And you can go over and you can look at people look at leverage and they get a little nervous. But let's check it out. So depending upon the broker you have, I'll say on FX, I mean, you could be 1-to-1, you could be 400-to-1 if you're outside the United States. If you're inside the United States, that's 50-to-1, which means you put up $200 to control $10,000. Okay, but of course you have the ability that could move and it could hurt. And then there's a lot of different strategies you can do. The risk can be capped or it can be greater than your investment when you're trading on margined leverage. Okay, and that's what keeps people sort of nervous. This also is what has wiped out a lot of traders over the years. So let me put a comparison up on just say the euro dollar on margin, because I want to show you how powerful the Nadex margin is. Well, if you're going to go in and you're going to trade the FXE ETF, you'd have to buy 1,000 ETFs. Okay, let's just say it was priced at $125, and I know these prices are a little bit outdated, but I can't update them constantly. But because the euro's at 1.250, whatever. Well, you'd have to put up 125 grand. Maybe if you have day trading margin, $31,000 to place the trade. Okay, that's a leverage of 4-to-1. If it moves up to 1.2740 from 1.250, then you'd make $3 grand. If it moves down to 1.2250, you'd lose $3,100. And again, you have to put up 31 grand to even do that trade. If you're over the spot market, say on a 50-to-1 leverage, then you only have to put up a lot better, $3,000. Okay, what over 3 grand, and you can go in and take advantage of that. You make 3 grand if it moves up, you lose $3,100 if it moves down. If you go to the futures market, you get even better leverage. You can get as low as $500 day trading at margin. That's 250-to-1. If it moves up, you make 3 grand. If it moves down, you lose $3,125 on that same move. Or maybe you hop over and you look at the euro dollar, future options. They're priced at basically about a penny an option. You have to buy 125,000 at once, and so you go in and you're putting up quite a bit of money, $2,500 on it. You can make $463 if it moves up, and you could lose $1,250 if it goes down because of gamma and delta and theta and all that stuff, which can make it really not the best choice using the options. Okay, now you go to the Nadex spreads, and let's check it out. Okay, same thing. And what we do is basically put up 12.5 because you can't do half, but had to equalize it all. 12.5 spreads, and you're putting up $250 on the trade. You're getting 500-to-1 leverage. You make $28.75 if it moves up to that same price, and you only lose $250 if it moves down. And you can never get stopped out of the trade, which means it could go way down and come back up, and you could still end up making money on the trade. So I just want to show you the power: 500-to-1 leverage, and I see 1,000-to-1 leverage all the time. This isn't even the best example. So I could show you a lot better examples where you're 1,000-to-1, 1,200-to-1 leverage with completely defined risk. Okay. Now the Nadex exchange right here, all of the products are capped. You can never lose more than what you put up in margin. Okay. So if your risk is $250, or if your risk is $25, okay, if your risk is $10, whatever your risk is, that is your margin. And no matter how far it moves against you, your risk doesn't increase, and you can't get stopped out. But you still get the massive leverage in your direction. You can trade a variety of major stock indices like the S&P 500, the Russell, the DAX, the Nikkei, you can trade the Dow, so NASDAQ. There's several of them, so you can go out there and take advantage of. There's future commodity markets. You got gold, silver, copper, natural gas, corn, soybeans, oil. So you can take advantage on those. What about forex pairs? We got euro dollar, pound dollar, Aussie dollar, euro yen, pound yen, U.S. Canadian, U.S. franc, U.S. yen. So on down the list. So there's a lot of different markets that you can trade. And again, I want to remind you, we talked about this already, but price is driven by the underlying market. Okay, so if the market goes up, it goes up. Market goes down, it goes down. Now here's one of the most important things, and let's pick this up, and then we can start walking into the details of what a spread is. Yes, ES, John, exactly. So ES and Q, YMTF, all those, which are future symbols for those that don't know. Every single spread moves in, either a pip or a tick. It's the last digit of the quote. It'll always be an increment of 1. So either 1 or 0.1 or 0.01 or 0.001 or 0.0001, like an FX. Every single tick is always worth $1. Okay? So now I think Morgan posted a link a little bit higher for you if you're outside the US. It's at $1 per spread. All right? Per point, per spread, which is awesome because if you trade like the E-minis, right, you got to know, okay, it ticks in quarters, every tick is worth $12.50. If you're trading gold, okay, it ticks in 0.1, every tick is worth $10. If you're trading oil, every tick is 0.01, it's worth $10. And you got 8 cents and all these other different things. If you're trading in pound yen, you got to convert from pound to yen, so you got to yen to pound to dollar. It gets really, really confusing. Okay. Sam, Morgan, can you repost that link for everybody that's asking about the international? That'd be great. Jay, that's not correct. Morgan, can you post that up for him? So again, every tick is $1. So it makes it really, really simple to trade, figure out your P&L. All right, so let's check this out. We're going to have a spread right here. We're going to start the building block and work our way up. All right, so we understand the margin, awesome. Leverage, awesome. Defined risk, great. On an exchange, so it's safe, awesome. Okay, so all those things are out of the way. Now we're going to talk about what is a spread. You got the ceiling, you got the floor. Okay, on the ceiling, we're going to look at euro dollar as an example. And so the floor of the spread, you could call this the strike, which is already set, by the way. Okay, and we'll talk about that as how they set it and how it works. But right now, to sort of go with me to get the concept, and we'll build into it, and it becomes more and more clear as we move forward. So the floor is 2,400, and the ceiling is 2,500. Okay, so 1.240, 1.250. So you have 100 pip wide floor to ceiling. Again, you can do this on a lot of other markets. I'm just giving you a currency example. So the spread is the difference between the floor and the ceiling. Okay, so, and if you keep watching, I promise probably 90% of your questions will be answered. So the spread equals the difference between the floor and the ceiling. So, which is 100 pips, right? So 2,500 minus 2,400. And then the last digit is the tick or pip, or, if you trade stocks, you're used to the concept of cent, okay? That's your tick, that's your minimum move. And so in this, it's 1. So it's 0.0001. So every time it moves up 1 or down 1, that's $1, okay? So every pip is worth $1. Now, that's like a mini lot on euro dollar. So if you did 10 of them, that'd be like a lot, okay? A lot being 100,000 units of currency, a mini lot being 1,000 or 10,000 units of currency. All right, so we got that. The spread's value is 100 pips. Every pip's worth $1. So the spread's value, the max value of that spread is $100, the Nadex box spread. You can't lose any money. Let's say if you're selling the spread, you can't lose any money above the ceiling. So you can't get stopped out. So if you sold right here, it went up, your risk is capped, and you're still in the trade, it doesn't go up, you still have time for it to come back down. If you bought here, maybe you're doing a swing trade, and then all of a sudden, you do the swing trade, you have your stops, and then it stops you out, and then it flies up. Well, in this case, it went down, didn't stop you out, just stopped your risk, and you had more time to be right, okay? Now, you can't make money below the floor. I'm going to show you how to uncap this. And by the way, they have like 300 and 500 pip wide spreads. I'm just showing you 100 pip wide. But you can't make money below the floor. And again, I'll show you how to uncap it. So, if you sold the top and bought the bottom, the maximum value potentially would be $100, okay? So let's say you sell it And here's some real simple math, some rocket science math for you. Okay, if the ceiling is what you can't lose any money above it, and it's 2,500, and you subtract that from the sold price of 24.90, then your risk is how many pips? 2,500 minus 24.90 is 10 pips. So feel free to type answers in. They'll always be on the screen, but I want to help you out. Okay, so the risk is 10 pips. If you get this concept right here, then you're basically going to get the spreads. Okay, we just subtracted the ceiling that we can't lose above minus where we sold. 10 pips. Every pip is worth $1. All right, $10. And I'll show you some candlesticks. Just wait. So every pip is worth $10. Okay, so 10 pips, $10. If it goes down, you could make $90 on the trade on a $10 risk. I don't. If there's any FX traders on here, do you know how much you put up to trade just a mini lot on Forex? A couple $100. Okay, so a couple $100 margin. This is a $10 margin, a $10 risk. That's 1,000 to 1, over 1,000 to 1 leverage on this trade, and you can't get stopped out of the trade. So how many of you out there have got stopped out? I'm sure just about everybody. With this, you would not have been stopped out of your trades. You would have had time to be right. So now if we go over it, let's flip it around. And yeah, you wait for your price and you get out whenever you want to. Exactly. You can't lose money below the floor. You can't get stopped out if you're buying. You can't make any money above the ceiling. Again, I'll show you how to open that up. But if we go in there and we buy it at 24.10 and our floor is 2,400, the risk is the difference between 24.10 and 2,400. So 10 pips. All right. So 10 pips is the risk. And if you go in here, I'll bring up some examples here in a little bit. 10 pips is the risk, and $10 is the risk. $90 is the profit potential. Again, only $10 margin, not 200 something dollars margin. Okay. Exact same trade. You can't get stopped out. Other guy got stopped out. All right. $90 profit potential. So now the question is, well, do I have to? When can I get out? You can get out whenever you want to. Okay. So if you bought here, you could have bought here, and you could have got out here. You could have bought here, got out here. Whatever you want to buy, you could buy. You can sell whatever you want to sell. So you could buy, sell, sell. You could buy down here. So get in and out anytime you want to. Okay. So right there, and again, keep posting questions, and I promise I'll answer them. All right. So, but I want to make sure I stay consistent through the lesson because this is so new. If I stop on every question, then people just get completely lost. All right. So now there's a combination of markets, time frames, and spreads. So you can find spreads with a good floor or ceiling with a good risk-reward strategy to fit whatever trading strategy you're doing throughout the day. They have ones that start literally every 2 hours, which is awesome because that means there'll be a floor and a ceiling really close to where you are. And I'll show you what I mean by that on the next slide. You also can trade it for up to 22 hours and 15 minutes, okay, meaning starting at 6 and going to 4:15. But what if I want to trade a longer time frame? What if I want to trade days or weeks? Fine. Trade for 22 hours and 15 minutes and then open it again like a couple hours later, okay? So it'll close you out because you're done and then hop back in. You can just keep trading it. So you can trade this on longer time frames just because the contract is 22 hours and 15 minutes. And it's actually really good because you think about it, if it flies up and you're still wanting to hold on to the euro dollar longer, great. Put on another spread. And now you've locked in your profit because it'll have a lower floor. Okay? And yeah, I mean, you can do this overnight trades. You can do this at nighttime trades. You can do this in the morning. You can do it in the afternoon. I mean, I literally did trades at 7:30 at night. I've done trades at 4:30 in the morning. I've done trades at 7:30, 8:30 in the morning. I've done trades literally at 4 o'clock Eastern time. They're 15 minutes long. So whenever you want to trade. Now, the longer the time is until it expires, the wider the spread will be. Okay? And they have expiration and settlement. So basically days of expiration, time of expiration. By the way, everything on the platform is quoted in Eastern time. All right? And we talked about the spread range and width already. Number of contracts per expiration per range. And again, if you go to our site, we have links to all the contract specs and everything. Just go to tradingpub.com/apex. Trading hours. So that's times when new trades can be entered into and opened, and you can exit whenever you want to. So right here, this is an example for you. Now, it looks really complicated at first, but let me show you what's going on, okay? One is we have this what's called a master spread. It'll be huge. Okay, so it's like the market's like right here, and so a spread opens up to the end of the day. It's 3,300 and 2,700 the floor and ceiling. Probably not the one you want because you don't have that big benefit of the floor and the ceiling in your favor. You can lose basically as much down as you can make up. Okay, but if it flies way down, you want to do a reversal like on a flash crash day. Whew, perfect. Okay, flies way down, grab it, pops back up. Excellent, got a low risk trade. And what they do is they have a floor to ceiling on it. So if we look at this right here, we have basically 125 pips, wide, and that's what it is on the pound, or the euro or whatever. So they have different ones for different time frames. But 125 pips. So let's say it's 125 pips wide on the 2-hour expiration spread. So like they start at 8 to 10, 9 to 11, 10 to 12, whatever. And they'll put 125 pips above where the market's at right before it opens. 125 pips below where the market's at right before it opens. And then they'll put one in the middle. Okay, so 125 pips like here and 125 pips here. So basically 75 up, or not 75, I guess it'd be 60, something up and down. Okay. Now, this one's a little bit longer expiration. Okay, so this one's, 8 hours. So we can see right here is on the 8-hour spreads, they're wider. So they're 250 pips wide. So notice how longer time frame, bigger spread. All right, and 250 up, 250 down. Then they'll have one that's basically strangling at 250 up, 250 down. So 125 up, 125 down. Okay, and they'll have constantly new ones. So let's say the market's up here in a couple hours and they launch the new 2-hour ones. It'll be 125 up, 125 down. So it's always a spread close to you. And so what you got to do right here is look at, it is 250 wide if you're looking at this and this, but make sure you're looking at there's a ceiling 2 and floor 2, ceiling 3, and floor 3. So that way you're matching them up where you have the numbers on there. So it's actually 250 up, 250 down. And they constantly are opening these up. And I know this seems really complex, but I mean, it's no different than like you're buying right here, your risk is at the floor, you can make money up to the ceiling. Or you're selling right here, your risk is down, or your risk is up to the ceiling, you can make money down to the floor. Or you could do both. So one of my favorite trades, I used to hate news. Now that I trade Nadex, I love news. I'll go in and I'll straddle these things like crazy. So right before Fed funds rate, right before unemployment, right before non-farm payroll, right before oil inventory reports, right before interest rate announcements on Aussie, Euro. I mean, think about this week, right? We had a massive Euro announcement, and really the press conference is what made it fly. You go in and you straddled on the Euro. And you basically buy one above it, sell one below it. Who cares what direction it goes? You know it's going to go somewhere. So, and yeah, they do have demo. So right here, okay, so let's keep going. They provide spreads on a lot of different markets like I already went over. So euro dollar, pound dollar, Aussie dollar, US yen, euro yen, pound yen, US franc, US Canadian. They have commodities, corn, soybeans, oil, natural gas, gold, copper, silver. They have indices like the S&P E-mini, NASDAQ, Russell, Dow. Now understand, if you're an ETF trader, you're getting better leverage, okay, and less risk, meaning less money, more buying power, less risk. They follow the futures. They don't follow the SPX. They don't follow the SPYs, okay, like the spiders. They're not following IWM, things like that. Okay, they're following the actual futures. And on our site, we actually have how to get free futures data, live futures data. So if you don't have that, because it can cost a few $100 a month, we show you how to get it for free. So if you hop in our site, you'll be able to take advantage of that. Also, FTSE 250, the DAX, the Nikkei. So any one of those markets right there, they also have available for you to trade. And yeah, gas is crazy. So it moves 1 to 4% a day. The whipsaw elimination strategy is the one that we're going to go into, and then we'll build onto that with it takes one slide to show the ultimate hedge. Okay. And it's pretty sweet. Like I said, you already got the spreads down. We're going to talk about how to combine Forex spot. Now you can also do this with futures. You can also do this with indices. And I'll also show you a quick way, an easy way to find the best spreads. And we'll talk about how to make the market, how far to make the market move. So earlier, I showed you this example. We went in, we said, hey, trend line. Okay, we're going to go short. We put a stop up there, and we sold. We had 650 risk, $3,000 in margin. Market knocked us out, fell down, and slapped us in the face. Okay? And I don't trade Hong Kong Sing, so I can't help you on that one. Nadex spread examples. So what we're going to do now, let's look at this exact same thing on a spread. The spread, 5,700 is the ceiling. Okay, it goes down to the floor of 54.50, so 250 pips wide. Okay. We're going to sell the spread at 56.65. We have no stop loss because we don't have to, because we basically have no stop trade. So our risk is the difference between the ceiling, 5,700, and 56.65. Okay? So that's our risk right there. That's 35 points risk. How much? What is a point or pip or tick or whatever? What's the last digit worth? Every one of it's worth $1, right? So if we're doing 10 of them, then every pip's worth $10. If there's 35, pips of risk there, then that's a $350 risk. $350 in margin, by the way. Remember the last one? The Forex trader did the same trade? $650 in risk, $3,000 in margin. So we have less risk, and we're putting up less money. Well, market goes up. We're down. Okay, we're not happy, but we're not out. We don't have to put another trade on. We don't have to make that decision. Do I go short again? Do I go long again? Do I sit on my hands? We don't have to take on any additional risk to still be in the same trade. And then the market flies down and expires. And now you can hold its expiration and they'll expire at where it's at expiration, okay? Or you can close it early, either one. And by the way, when it expires, like you get your money paid out in like a few seconds, right into your account. You don't have to wait till the next day and the settlement is the expiration at that time, okay? So this one like started at 2 and went to 10, for instance. So expires at 1.5589, or we got in at 2, got out at 10. 1.5589, the profit, $760. So we made $760, and we compare the two. Both of us traded pound dollar. The spot trader risked $650. We risked $350. Spot trader put up $3,000. We put up $350. Spot trader lost $650. We made $760. So exactly, cash settlement immediately. Now, one thing I want to point out to you real quick is you don't have to do 10. Okay? So you could go in there and do the exact same trade. You could sell just one, just $35 risk. Make 76. That's a 200% return on your investment. Okay? Yeah, exactly. That's a good point. Mike, I'm glad you're bringing that up. There's no assignment. So you're not getting assigned FX. You're not going to have gold show up at your door. You're not going to have any cattle delivered to you, nothing like that. So no stocks assigned to you, no futures, forex, or commodities assigned to you. It's just instant cash settlement. All right? So you don't have to worry about what happens if I get exercised, because there is no exercise. I mean, you close it or it sells. All right? So, I mean, 200%. And this is not abnormal. Okay? Morgan's seen me. I've been on Morgan's webinars. We were on the other night with Morgan. We did a quick trade. People were badgering me like, trade. And I'm like, I'll trade when I'm ready. And trade came up. We hopped in 15 minutes. We made 100% return on our trade. So, I mean, this is an awesome, awesome way. And let's see here. Yeah. Let's see here. Yeah, no restrictions. No restrictions. $100 in your account, you're good to go. Obviously, I recommend you put more in there than that, but that's all you need. You can place trades. 6 p.m. to 4:15. 6 p.m. one day to 4:15 the next day. All right. Now, this strategy, okay, we're going to go to the ultimate hedge. So you understand the spreads. Now we're going to go to the hedge. That's where you combine it with like the FX or the future indexes or the future commodities, okay? This is also known as the open box strategy. And we're actually a little ahead of schedule, so I'm going to really answer all your questions. This is awesome. Hopefully I didn't go too fast. So again, I call this the open box because now you're not limited in your profit, which usually, honestly, I mean, come on, 30-point wide, S&P E-mini, you really shouldn't be that worried about making only 30 points on the E-minis, But I know there's days, but you really shouldn't be that worried about it. But if you want to combine the two, which I love doing this, by the way, especially if you're a scalper, this is an awesome strategy. If you're a swing or trend trading, it's a great strategy, okay? You go in here and you can do this on these markets. Here's the reason is because they're actually priced in dollars, all right? So if you're actually trying to go and trade pound yen spot, it's priced in yen. If you trade the DAX, it's priced in euros, so that creates a little bit of a currency conversion issue. But you can do it on these markets right here, this hedge strategy. what we're going to do is same trade we were looking at before, okay? But we're going to, and you may not even want to do this. I'm just showing you this is a way to do it. You have the spread floor at 5,700. So maybe you're just like, I'm trading FX, you know. Okay, just trade FX, but hedge it. All right, quit getting stopped out. Spread ceiling is 59.50. So we're going to buy 10 of them. Now, it's a little bit out of the money down here when we actually decide to get in, so it's only going to cost us 57.10. All right, which means our risk, 57.10 to 5,700, okay, it's only $100 on the entire hedge that we're putting on. Now, if it goes up to 59.50, we're going to have to close out our Forex trade, but our Nadex spread trade is going to have made that money, so we're okay. All right, our net between our two accounts is good. So you don't have to wait till it goes all the way up. You can just decide I'm done and get out, but you could stay in and see if it comes back down. So we're going to sell a lot of spot Forex. Now, you do got to put up $3 grand, okay? And basically, your stop is now 59.50, by the way, okay? It's no longer just like right above this little line over here. Well, the market moves up, and then the market moves back down in our favor. So what happens? Well, we sold the spot at 56.85. We bought the spread at 57.10. So our risk on the trade, meaning the spread was making money above 57.10, okay? And we had to make basically 10 pips on the way down to make up for the spread cost, was 35 pips. So we had a $350 risk on the trade, but we had no cap on our profit. And so we came down, let's just say we sold out when it expired at 55.89. You know, we made $960 on Forex. We lost $100 on the spread. We netted $860 profit. Now, you don't have to close when the spread expires. You're in profit. You can just be trailing your stop down, okay? But, you know, let's just say you decided to close. Then you could close it on. Or let's say you have on a longer-term position, and this is huge. This is one of the ways to use it. Let's say you have on a position on euro-dollar, and you're long the euro-dollar, but all of a sudden you know the euro-dollar interest rate announcement press conference, something's about to come out. And you don't want to get wiped out when it does, but you also don't want to get out. And you don't want to get stopped out, you know, so you're trying to figure out what to do. You can put a spread on through the news announcement, let it do its thing, and then take it off and make that money in your Nadex account. So there's a lot of ways that you can use this, okay? Yeah, so you'll need the margin over in your Forex account to cover it, but the net of your P&L between your two accounts would be there. And again, same thing. You could have just done one lot, one mini lot, all right? So have a very low margin. Actually, that'd be lower. That'd be like $300. Sorry about that. $35 on this side, and you know, you have a $86 profit on the trade. So you could have $300 here, you could have $10 here, so you had about $400 margin, made $86 on the trade if you're trying to do really small sizes. Now, one of the things, people go into these spreads, and when you get in the Nadex platform, they are confusing. Okay, and as a trader, I loved the spreads. I'm like, this is the best thing in the world. You know, I'm not Nadex. Okay, I'm a trader. And I teach for Nadex all the time because I love it and people really enjoy the education. They ask me to teach for them. But, you know, it was just too much work because you have like 26 spreads to choose from at any given moment. You know, long 13, short 13, and then you're going at all these different expiration times. And I'm like, I just don't have, like, when I'm ready to buy, I'm ready to buy. I don't have 30 minutes to figure out what the best spread is, okay? And, you know, Bill, to answer your question real quick, the spread is determined like about 5 minutes before that market opens up. So if the spread's going to start trading, say at 6 p.m., wherever the market is at like 5 minutes before that, and it stays 250 pips wide, they'll put 250 pips above it, 250 pips below it, and then they'll straddle with 250 pips. So that'll determine the floor and the ceiling. It's automatic. Okay. But I just didn't have time to go in and find the best spread. Like, it's hard enough to hop on the chart and make your decision, and then spend 30 minutes trying to figure out when to get in. Your trade's over. And so what I did was I basically figured out all the math. I built this big Excel sheet. But then I still had to enter all the prices, and I was like, all right. So then I got one of the partners here at Apex to help build a full API that ties into Nadex, and so we can actually get all the Nadex exchange data live right into our server and then display it on the scanner. And you can get access to this. You can check it out for free. Just go through that link, and you can choose whatever market you want. So S&P 500, Euro Dollar, corn, gold, whatever. And then you can put in like, I don't want to see any spreads that don't have at least a 1-to-1 or better risk-reward ratio. And I'm going to go here on maximum risk, and I don't want to risk more than $100. Okay, and it'll automatically filter all the spreads down to like the 2 or 3 best that match. I can say buy, sell, or both. Maybe I want to do a straddle. All right. And a lot of people go in, wait a minute, why in the world would, and I think it's a question that's sort of coming up, why in the world would a market maker take on that kind of risk? Well, remember, if you're buying at 10, somebody could have sold higher and bought back lower. So it's not necessarily the market maker taking it on. All right. So they literally it could be another trader just filling your other side of the trade. So they're taking a profit on the downside. Now, when you're buying in, thinking it's going to go up. So the whole risk reward is a little bit, don't think of it like the market makers, and plus the market maker is massive. They do millions of contracts a day. They hedge their stuff off like crazy. All right, so right here, like it's showing all the spreads, but it'll narrow it down for you. And you can even say, time to expiration. I want 20 hours or 1 hour or 30 minutes or 2 hours till expiration, whatever. And it'll go in here and it'll say how many minutes are left till expiration, if it's in the money, deep in the money, out of the money, which isn't incredibly important, but I do talk about it a little bit. Break-even distance, like how far does the market have to move? One of the big mistakes people will take when they make these trades is they'll go, oh wow, look at that spread. There's only a $5 risk. I can make 291 bucks. That's the one I want. It has to move 9.5 points because the floor is way above it. So the floor is like 9 points up. Okay, so that's not a good spread to buy because the S&P has to move 9 points. So that's why that number is important. This one, right here, it only has to move 1 point. This one, it doesn't have to move at all. It's trading on par. But you see risk, you see profit. Okay, you see risk reward ratio. And then another thing we have built in, I know it's a little hard to see, but you'll be able to see it a lot better once you log in. And it'll go live tomorrow at like 6. With all the markets, it'll go live like the following day on Monday. But then you can see the hedge. Just say, if you want to hedge. So if I wanted to buy this spread, and there's actually a buy button right here. I know it's pretty dark, but there's a buy button. If you click on it, it opens the order ticket in Nadex for you. You just have to hit buy, actually hit submit. But it'll show you like how much is the risk with the hedge. This is doing a full S&P E-mini with 5 spreads. Okay, what would be your risk? Like this one right here, my risk on the trade would be 37 bucks on a full E-mini. I mean, that's not even 3. That's 3 ticks of risk. Okay. If it moves a couple points, I'm break even. After that, it's pure profit. Okay, and also it'll tell you what the ratio is, like 5 US 500 spreads to 1 S&P. So I don't want to go into that a whole lot because it'll get more confusing. But it's pretty simple. Basically, an S&P E-mini is worth 50 bucks a point. So when S&P E-mini moves 1 point, it's 50 bucks. Well, these tick in 0.1. So if it goes from 40 to 1441. If it's ticking in 0.1, that's dimes. So that's 10 pips, which is $10. So you need 5 of them to make 50 bucks a point. So if you did 5 US 500s and 1 E-mini to do the ultimate hedge strategy, your risk would only be $37.50. And it does all this math for you, so you're not trying to figure it all out. Now, the other thing we have, and this is massive. This is insanely accurate, okay? And if there's any Apex students on here, they can definitely talk about it. But I do what's called diagnostic deviations, okay? Yeah, if you click on that link right there, then Morgan will nadex.com, or not Nadex, but tradingpub.com/Apex. You'll get all the TradingPub videos. So right here, if you go in and I use what's called diagnostic deviations. I don't use, you've heard of pivot levels, you've heard of fib levels, okay? You've heard of ATR, you've heard of standard deviation. All these are based on yesterday's movement, okay? Yesterday's price action. What you want is not yesterday's movement, you want today's movement. You want to know how far is the market going to move today, okay? And what this does, we take the implied volatility. I know one of the other commentators was talking about Vega and implied volatility. We go in and we take the implied volatility out of 16 different options, and we have a weighted scale formula we use on them, and then we tie that into an intraday, one-day deviation formula. And it tells us how far the market's going to move on any given day and what the exact levels where the hesitation will be. It's basically statistics in black and white, so you don't have to do any math. And when I say accurate, like insane accurate, okay? Market stops on these levels, turns around, goes the other direction over and over and over again. And so we have, you can hop on here, and one of the cool things is actually when you highlight over it, it'll tell you what the month is that the Nadex contract's following in the symbol in both, like, say, Ninja format, Thinkorswim format, whatever. Like ES0313, because if you're new to futures, you have no idea what that is. So that makes it really, really simple for you. And even if you're not new to futures, at least you know exactly what contract they're following. And we have it broken down for the futures markets themselves, for the front and back month contracts, for the spot forex, and for all those different areas. So so you can do straddles on them. And so like here's like this one example of gold just from the other day, from the first. We went in and did a gold trade on this, and notice how it went up, and we stopped at 1 deviation, which is where we expected to stop up. Went up to 1.5 deviation, reversed back down right to the settlement. And I did a straddle on this, where I bought this one right here. Actually, I sold this one at like 16.49, right before the news came out. So my risk on the trade was $10 on the sell side. Okay, well it's capped. Notice how it can't lose anything above 16.50. All right, and then let's see here if I have the other one on there. Okay, then the other one, where is it? I know I have one more. There it is. All right, this one right here, I bought it at 16.64, about to wrap up, or 16.54. So I had $40 risk. So I had $50 risk on the total trade, okay, on just one contract on each side. Market ran way up to our deviation level where we were able to get out and able to make several $100s on the trade with no risk. So it's a 500% return in a matter of a few minutes. So about an hour and a half. Actually an hour. So we got an 8:30 out at 9:30. So massive return, $50 risk, make several $100. I mean, just one of the many types of trades that you can do over on Nadex. So hopefully you found some value in these strategies. And you can check out some other things that we have. We plot in the deviation levels live into some platforms. You can see like right here. I'd actually plot in stop, 1 deviation plots in, so over and over again. And
all right, great. Thank you, Darrell. We really appreciate you being here. I think the comments spoke for itself. Very interesting, and you did an outstanding job of teaching that. So, and again, if you guys liked that and thought that was kind of interesting, we've got a bunch of videos that you can get by going to tradingpub.com/apex. and just put your information in there, and then it sends an automated email with lots of the recordings. And like I said, you get a 2-week demo with Nadex. If you want to get that extended to a year demo, send Dan an email and just tell him that the guys at the TradingPub told you that he would do it, and that a lot of people witnessed it, so he has to do it. All right. So, all right. At this time, I'm going to turn things over to our next speaker, Tim. Tim's kind of interesting. He's had the opportunity to interview hundreds of traders, and basically what he's done is put together a session based on things that he's learned from working with some of the wealthiest traders that he's been around. So Tim, if you can, come on real quick, tell us about your background. I'll get your slides loaded for you. And just a reminder, we've got 2 more sessions left. Tim's about to come on, and then he'll be followed by Kyle, and I will come on and talk a little bit kind of about the evolution of trading. We have recorded all of this. We'll try to get copies of each video recording edited and posted on our website, hopefully on Monday afternoon, and emailed out to everyone. All right, Tim, you can take it away.
Okay, guys, let me know if you can hear me okay. I'm just using a headset here, plugged in a little bit ago, so just give me a quick heads up if you can hear me.